Okay, thanks everyone. Yeah, I'll just move on. I'll start first because I have another meeting later. Just on the first one will be on Penguin. We initiated coverage on Penguin with a target price of with a buy and target price of 61 cents. Just to give you a bit of background, Penguin was actually a pretty old company. It's been listed since 1997. They have 2 yachts. And I think the most, in terms of the key milestones, was they actually disposed of their ferry ticket business, so they're not involved in it anymore. And the 2 important events was that they won a contract from the Ministry of Home Affairs for 3 vessels for the SCDF. Mainly, you can see from here, it's a fire and rescue vessels. And in 2018, they managed to secure a patrol boat contract from Australia and also some offshore wind support vessels. So this is meaningful because their usual business has been crew boats and also security vessels. So this is the first time they're venturing successfully outside these 2 core areas. In terms of the business model, most bulk of the earnings still come from shipbuilding, but what is growing is also the revenue from their chartering business. They right now have about 15 crew boats in Malaysia. I'll explain what they are. And below, just some pictures of their 2 yachts and also the contract that they won end 2016 from together with ST Marine for SCDF. Sorry for the missing word here. Yeah. Okay, and anyway, I'll just go through the shipbuilding business. Okay, these are the shipbuilding. They build almost many types of vessels, but the 2 key ones, the core ones, have been these offshore crew boats. You can see from here. What this vessel does is that it actually ferries crew from onshore to offshore, and also just to move crew, as they, crew offshore actually have multiple shifts, so they move them onshore, offshore, and also move them between rigs or platforms. These are all branded under the Flag series. So that's the reason for the corny title, Flags and Fly. Okay, but anyway, I'll move on to the second. The other core product that they manufacture is security boats. This is a bit of a niche product. They sell it to all companies. And these vessels, as you can see, actually, they are actually machine gun mounted here. Of course, they don't sell these machine guns, but these are vessels that are deployed mainly in Nigeria to patrol offshore facilities in Nigeria. Okay, so these 2 are the core ones. But what has helped them grow, apart from those 2, is the growth in other type of vessels that the new vessel types that they're building. They managed to secure 1 contract they managed to sell 1 passenger ferry to an African customer. And also another milestone was they managed to win a contract last year for 7 patrol boats from Australia. And also last year they won 2 vessels, wind support vessels from Taiwan. And also, like I said, N16, they won this fire and rescue. These are huge vessels. Just can't really see it from the picture here, but for the SCDF. So these are meaningful because they're venturing outside their core crew boat and also armored vessels. Okay, the other part of the business, which is 20% of revenue, is the crew. This is the usual charter business. They charter they rent out these vessels. These are mainly in Malaysia. The rent is about 4,000 or 5,000, but actually it's actually creeping up. What's happening in Malaysia is that they're replacing the expensive helicopters, because in the past when oil prices were higher, they were moving for crew. They were ferrying all these passengers onshore to offshore using helicopters. But what has happened is that as oil prices actually collapsed, they actually cancelled the helicopter contract. The other part of the income, which is not in revenue, but it's quite meaningful because it's almost 3 to 4 million per year on average, which is actually what happens is that opportunistically they will dispose of their crew boats, convert them to security vessels, and they normally generate about 3 to 4 million net income. So they make about 17. So this is quite meaningful. Almost 30% of income comes from this part of the income. So basically, there are 2 business models, but one thing to note is that they build to order. That means you got actual orders, then you build. The other part is they build to stock. Sorry about this 15. They build to stock crew boats and also armored vehicles. So when you build to stock, obviously there are plus and minuses to it. The advantage is that you get better margins because the buyers can charter out, because they can get the delivery of the vessels fast, so they can charter out earlier. So you get better margins. Of course, the downside is that you always have the worry of inventory overhang. But what's important is that when you build to stock, you need to build where the demand is continuous, and also the vehicles must not be too specialized. So that's part of their business model. In terms of outlook, we think the outlook will be good this year. At least what happens is that, as you know, all prices are recovering, and you can see from this chart here, these are the amount of offshore rigs that are being deployed globally. And they will benefit because most of their vessels are used in the oil and gas, especially their core crew boats and armored vehicle vessels. And also they are getting larger share as competition decline. I think one of their competitors was actually a Triad subsidiary, which actually went to liquidation. So what we noticed from the industry data is that their market share has actually climbed from 35 to 60% for aluminium boats of that length. The core product is aluminium boats compared to steel because they are faster and lighter. So that's they specialize in aluminium boats. The other thing that we like about them is the order momentum outside the core vessels. 2018, like we mentioned, they secured patrol boats and also wind farm. So that is in terms of orders. They do not disclose their order book. In terms of the investment thesis, we like them because they managed to expand outside their core, and then we expect more vessel deliveries or vessel orders, and also the rising charter income. As you can see, offshore activity in Malaysia, at least in the dark blue, is recovering. So that will also support their charter income. And also, of course, they got a healthy balance sheet. They exited 2018 with almost 40 million net cash, and their market cap is about 100 million. So they're trading, excluding cash, about maybe 3 to 4 times PE. So in terms of valuations, again, it's very hard to value because hard to use this year as this is cyclical. So what we did is we just used the PE ratios of the two smaller yachts when the cycle was more steady state. So this they average about 5 times PE, some almost 8. But if we use that, what we did is we took 5 times PE and then we added back the net cash, we get about 61 cents valuation for this company. So we initiate coverage at the buy with 61 cents target price. Okay, thank you. I'll move on to Singapore Exchange.
And moving on to Singapore Exchange. The main positive for the exchange, Singapore Exchange results this quarter is for derivatives. So this is a third consecutive quarter of record revenue for derivatives, and this is mainly due to a volume increase by 12%. So equity derivatives grew 8%, FX futures volume grew 48%, and then iron ore derivatives grew 30%. And in addition, average fee per contract rose 5% from $1.06 to $1.11, mainly due to the pullback of rebates for China A50 as well as a 30% higher volume for higher margin iron ore derivatives. So as of 3Q19, derivatives contributed 52% to the total revenue in 3Q19. So we forecast a higher FY20 DDAV of 1,107,000. And this is 15% above the 9 months DDAV of 963,000. And for SGX, the negative this quarter remains as the equities. So equities revenue fell 30%, which is the lowest in 5 years. And this fall is mainly due to the weaker market sentiment, as usual, as from the past 3 quarters that we saw. And the significant fall in SDAV was partly due to a high SDAV last year in third quarter 18 of 1.45 billion, which is the highest since 4Q13. And also average clearing fee declined as well. And our 9-month SDAV estimate was 5% above the actual 9 months SDAV. So we lowered our estimate from 1.08 to 1.02. And as similarly, we also pen in a more conservative SDAV for FY20 by 5% lower than our previous estimate. So the update for SGX and the NSE arbitration. So the management has announced that they have already submitted the proposal to the respective authorities, and no additional details can be provided at this point. But from the tone that he gave, it was a rather positive proposal that both exchanges agreed upon and will mutually benefit each other. And the second one is the competition for Hong Kong Exchange. So SGX, they do not expect the absolute volume for China A50 to be affected. Although if Hong Kong joins in as a competitor, market share will definitely be affected as well. And one of the strengths that SGX said that they have is that a vast majority of the clients trade a range of products with them. And SGX offers margin offsets across all their products, and they have a good track record of clearing these products as well. And in addition, the liberalization of the Chinese market with higher onshore activity in China, it usually creates higher offshore activity as well, as people need to hedge their own exposure as well. So this in turn creates a larger market for both exchanges and will benefit both of them. So for investment actions wise, we maintain accumulate at a lower target price of $8.09, previously $8.17, as we peg our target price to 21.4 PE, 1 ST below their 5-year mean. So the lower target price is mainly due to our DDAV and SDAV adjustments. So we still believe and we are still positive on SGX, as we believe that continued stock market volatility should support the derivatives volume growth, and the boost in derivatives volume and increased product offerings such as DLCs and their FX, INR and CNH FX derivatives will be more than sufficient in offsetting any shrinkage in the securities business, as well as supporting the overall earnings growth. So SGX remains as a defensive stock with consistent and diversified business model, and their valuation and dividend yield remains resilient in an uncertain environment. So next, I'll pass on to Tara for CapitaLand More Trust.
Hi, so I'll talk about CMT's 1Q19 results. You can see on the top line, the main contributor for this quarter would be the Westgate consolidation. If you recall, last year in November, they acquired the remaining 70% of this asset from via the IMT vehicle. So this quarter be the first full quarter contribution from Westgate. Previously, this was reported at the associate level. Right now, it's consolidated on the revenue line. And the other positives from these results is the stable portfolio occupancy, especially for Tampines Mall, despite the ongoing AI that it just finished, as well as the opening of Jewel, which is one of the new competitors that came on the scene, given that it's located in the east as well. And for this quarter, the tenant retention rate was pretty high at 88%. The previous quarters were all at the low 80s, the low 80+%. The update on Funan was that it's currently pre-leased at 90% occupancy overall for the retail and office components. The previous quarter, the update was 80%. So some of the media reports have actually reported that some of the office leases have been taken up by a slew of government agencies. And Funan is expected to contribute to CMT from the second half onwards. The negative is that there's pretty weak reversions still continuing on for this quarter. So the whole of FY18, they reported about barely a percentage point of rental reversion, only about 0.8%. And this quarter, slight improvement, about 1.2%. But this is still lagging behind the peers, such as Style Global REIT and FCT. So for Style Global REIT, if you take their Clementi Mall, as well as the Paragon, the average is about 5%. And for FCT, it has been ranging about 4 to 6% on average for the past few quarters. So that's lagging way behind their peers. And on top of that, tenant sales also slid about 0.4% year on year. This is notwithstanding the continued decline for the past few quarters. And this was dragged down by more trade categories this quarter as opposed to the same quarter a year ago. Outlook-wise, we noted that IMM, which is their second biggest contributor by GRI, had its lease renewed for another 30 years. This was a previous 30 plus 30-year lease. So right now, the property is standing on a 30-year lease. And with the Jurong Lake District shaping up under the URA draft master plan, we can foresee the IMM as well as Westgate to benefit in terms of reversions and valuations going forward. And also, the recommencement of the further operations can be expected to improve the overall portfolio occupancy as well as the reversions going forward. So we maintain neutral with a higher target price of $2.21, mainly to reflect a lower cost of equity. And our target price translates to a 5.4% distribution yield and a price to book of 1.06 times. Moving on to FCT. For FCT, this is their 2Q19 results. So there's a little bit of improvement still on the top line. This is mainly due to the improved occupancy and revenue at North Point North Wing, which just stabilized after their major AI that was completed in the early part of last year. And MPI level, you're seeing a little bit of increase as well, improved margins. This is mainly due to the lower property tax expenses. So there was some write back in terms of the previous tax expenses, accounting for the vacancy tax. And on the financing front, they were able to refinance most of the debt. So this year it's about 90 plus mil left for the rest of the year. And their average debt to maturity had been extended from about 1.6 years to 2.4 years. The negative is that the occupancy level took a bit of a hit. So Causeway Point and North Point, North Wing, if you recall, these two malls alone already take up more than 80% of the total NPI. And Causeway Point, their biggest mall, reported the lowest occupancy level of about 97+%. So traditionally, this asset has been very stable. The occupancy has always been about high 98 to probably 99%. So this 97% is actually the lowest in 25 quarters. And this was mainly due to the exit of 3 tenants related to New State. So New State, if you recall in the news, sometime late last year, they filed for liquidation. And this company, they own Newbox and many of the other tech companies. And however, the replacement tenants have already been secured. So the occupancy is expected to normalize in the next quarter. Outside of the results, so the other things that transpired during the quarter was the acquisition of stake in PGIM, Real Estate Asia Retail Fund Limited. Also, for short, we'll just call it PGIM. So in April, they successfully acquired a 17% stake. This is Singapore's largest non-listed retail mall fund. They hold 6 retail malls in Singapore, such as Liang Court and White Sands, and also 4 retail malls in Malaysia. So they acquired this 17+% stake for about 342 million. This was fully funded by a bridge loan, which will be eventually converted to a combination of term loan and or equity. So they've laid out some pro forma figures. Expected DPU accretion can be up to 3.56% with that's if they fully fund it with debt. And on top of that, we also noted that their sponsor FPL, Frasers Property Limited, had also acquired a similar stake, 17.8% in this fund, with plans to increase it up to 47.82%. So if we assume it's a successful acquisition of all these stakes, taking into account all this going forward, the total stake under the the full Frasers group would be about more than 85%. And outlook-wise, you can see we've laid out the table of the malls and the portfolio size for this PGIM fund. So their stake in this fund would further entrench their presence, given that most of the malls, especially the Singapore malls, share similar DNA to the ones in their current portfolio. And it also dangles a possible DPU accretion of up to 3.56%, assuming that the bridging loan is fully funded by debt. And also the Causeway Point stands to gain tremendously from the whole transformation of the Woodlands area under the URA draft master plan as well. So overall, we maintain neutral with higher target price of $2.31, accounting for this new acquisition of stake in PGIM as well as a lower cost of equity. So moving on to Guangzhou.
Okay, thank you, Tara. So next is the Singapore Coal monthly update. So what happened during March and May and April was that China, there were 144 million tons of new capacity added during first Q this year. So the authority approved of the resumption of work for 29 mines with total capacity of 177 million tons. So out of which 144 million tons were new capacities, and most of these mines mainly produce thermal coal. Meanwhile, the authority also announced to increase the coal transportation capacity by rail to 2.8 billion tons by 2020, which translated into a 30% growth. So these two moves prove that China is increasing the domestic production as well as to narrow the gap between the land-borne coal and the seaborne coal, because in the past the seaborne coal prices has been lower than the landborne coal, mainly due to the transportation cost differences. But right now, China aims to reduce the reliance on seaborne coal, which are mainly from Australia and Indonesia. So these two moves prove that China will demand for more domestic coal instead of the coal import. So on the Indonesia side, the authority will tighten the DMO requirement. So for the DMO requirement for this year could be higher than 25%, which was the quota for last year. So all these show that China at the moment has no intention to unwind the restriction on coal import. Meanwhile, we also think that the DMO has little help on relieving the pressures from the operational difficulties, which mainly come from the price headwinds. So at the moment, the Indonesian coal sector is still facing the lower ASPs. So these 6 charts shows our checker on the coal sector. So you can see here in March, the China domestic production increased almost to 5% year on year. And also in February, the coal import from Indonesia started to decrease. And meanwhile, the hydropower in March spiked. So this chart is quite important. The coal price reference in Indonesia dropped to a 20-month low. So in April, the price was about $89 per ton. And for the China domestic, the port coal prices, you can see is stabilized at around 630 RMB per ton. And you can see here also the port coal inventory growth dropped significantly recently, and also the level of coal inventory stabilized. Next, I will pass on to Mike to talk about China updates.
Thank Guangzhi. For China last week, based on our feedback of China's seminar, most investors are kind of wondering why the Chinese stock market are trembling down last week. For China last week, Shanghai complex down about 5.6%, the most weekly down since the 2018 October. We think it's mainly because of the April 19th meetings. China's government announced that coming to the second quarters, they will adapt more modest and more cautious monetary policies. So markets are worried about the tightening liquidities to affect the stock market. But based on observations, we observe that for last week, PBOC released 267 billion RMBs the TMLF to the market. The TMLF is mostly focused on giving rooms to the small and medium-sized companies, and this is the second time the PBOC used these tools. Secondly, the PBOC discussed the possibility first lowering down the RRR rate of a small and medium-sized company. So based on this, we are thinking coming to next quarter, this round of the monetary easing is will be not ended on the second quarters. Also, we are thinking the first quarters the liquidities already benefited companies. So we are seeing on March, the industry firms the profits rose 30.9%, better than expectations. For the stock recommendations, our Hong Kong research team recommend China East Airlines. Although although the oil price going up and the exchange rate lowering down the company's profit rate, the core business of the companies still remain strong, and the passengers turnover rate up about 10% year-over-year. So the Hong Kong research teams to give the recommendations, the accumulated recommendations, and give the target price 6 Hong Kong dollars. For this week, we are waiting for the decisions of the US and China talk. Also, we are waiting for the China March, China April PMI numbers. This is a list of Hong Kong research news recommendations for these quarters. That's all for today's webinars. Please leave questions on your question chat board.
Hi, there's a question on when is the estimated time for any EFRs in due to the bridging loan for the FCT stake in PGIM AFR. So actually they didn't state any timeline. They just said according to the prevailing market conditions. Hi, there's also a question on whether we have any view on the upcoming ARA US Hospitality Trust. Currently, we don't have any much info on it because I don't think they've lodged the prospectus yet. What you see in the media reports is just a term sheet that was viewed by the media. So that since there are no other questions, we will end the webinar for today. Thank you.